Hey, what's up, stock compounders? Brad here. So, Joel Greenblatt was interviewed by ETF Think Tank about a month and a half ago. And it's pretty unusual that Joel Greenblatt does interviews. So, today I wanted to share some highlights that I picked up from this interview with Joel. Many of you, I'm sure, already know Joel Greenblatt. I've talked a lot about the magic formula here on the channel. This is really the first book that Greenblatt wrote, You Can Be a Stock Market Genius. Now, he wrote this after a 10-year run from 1985 to 1995, where his fund generated 50% annualized returns before fees, okay? 50% a year. So just an incredible run. It was a concentrated value and special situations fund. After that 10 years, they gave all of their investors their money back and just continued to grow their own capital using that strategy. The other book I've talked a lot about on the channel is The Little Book That Beats the Market. And this is really all about the magic formula. How if you combine two factors to rank stocks, regularly, the first decile outperforms the second decile outperforms the third. It's all very predictable. So a very impressive piece of work with the little book that beats the market. But again, today I want to get into highlights from this video. So let's jump right in. I mentioned Gotham Capital started in 1985 for 10 years, 50% returns. Joel actually taught at Columbia University from 1996 to 2019, okay? 23 years he taught. It's pretty rare to find an incredibly successful fund manager who's also been a teacher, a professor at a university. Joel is a unique combination of those. I can't think of any others, really. I went to Wharton undergrad and grad school. This is Greenblatt. And they were teaching efficient markets. Okay. Now, all Greenblatt had to do was look at the paper to see there was something missing here. He says the 52-week highs and lows in the newspaper seemed to contradict everything the professors were saying. Most stocks traded in, say, a 40 to 100 range. So there's a huge disparity just over the course of a year between stock prices. And Joel really couldn't believe that the actual business value would fluctuate that much in a year. He came across an article in Forbes by Benjamin Graham. And that was really the beginning of his journey, reading about Ben Graham, reading about Buffett, to really teach himself this career in investing. Really, he says the only thing he learned in business school was accounting, which is obviously very important. But he probably didn't need to spend 6-8 years at Wharton to learn accounting. He defines value investing. Value investing is putting a value on the future cash flows of a business and trying to buy them at a discount to what that value is today. That's really all investing is. We're going to find out later, oddly enough, Greenblatt doesn't try to forecast earnings of businesses to figure out how to buy them at a discount. He's actually looking in the rear view mirror with his current fund structure in order to determine what's value. So we'll get into that a little bit more later. He says, if you do good valuation work, I guarantee the market will agree with you. I just don't tell you when. A big chunk of the time within the next 2 to 3 years, the market will agree with you and price will come in alignment with value. Sometimes you have to wait 3 to 5 years, okay? And Greenblatt is very big on this concept of time arbitrage, okay? The patient investor will win in the end. I think that was maybe his third book, The Big Secret about investing. It was really patience, right? Buffett talks about this. I think Ted Weschler talked a lot about this, where if you can have a 3 to 5 year time horizon on your investments, that's such an advantage over people who are trying to get that 1 to 2 year pop in stock prices. It's a totally different game, and it comes with a lot of advantages. Right, so the big chunk of the talk that I wanted to dig into was this chart that he shows right here. So Gotham has spent tens of millions of dollars. I think Greenblatt said, this is $50 million worth of data over the last 30 years to construct this chart. And what this chart shows is when their research portfolio has been this cheap, what kind of returns do they expect going forward? When it's been this cheap in the past, what has it done in the next 2 years? So it's now a good time for value. Now, based on where stocks are now, and this is how it's constructed, the largest 1,400 U.S. securities, okay, basically what they're going for is the least expensive 20% of those stocks, okay? So that's how the basket is constructed, least expensive 20%. The Gotham free cash flow yield, okay, this is calculated by Gotham. They have a huge research team. That's not something you can just screen for. But the estimated free cash flow yield of these cheapest 20% of companies in the largest 1,400 is about 14%, okay, free cash flow yield. Now that compares to a little over 5% for the S&P 500. So almost 3 times as cheap. It's the 92nd percentile towards cheap. So only 8% of the time in the last 30 years has this basket of the cheapest 20% of stocks been this cheap. Now, based on that, the average 2-year forward return, this is the expected return when the market has been this cheap in the past. This is how much it's returned in the next 2 years, 61%, okay? That's 30% per year for the next 2 years, according to data going back 30 years. So that's pretty interesting. To me, that says value is probably a very good place to be right now. Of course, again, this is very difficult to replicate for an ordinary investor. Tens of millions of dollars going into the research team and collecting data and all of that. But it's still very interesting. This is as of December 8th of last year. So again, about a month and a half ago. This 20% cheapest basket was this cheap in the 92nd percentile. And you can see this line here. This tells us, so this is a best fit line. If we know the Gotham yield, we can estimate the 2-year forward return. Since it's 14% for the yield, we're estimating 61% 2-year forward return. So this was a pretty fascinating slide. One thing I want to point out, the S&P right now is in the 28th percentile towards expensive, okay? So instead of 92nd percentile towards cheap, it's 28th percentile towards expensive. So quite a disparity between where the S&P is and where these cheapest 20% of companies are. And of course, this isn't a prediction, okay? There's nothing saying this is guaranteed to happen. It's just based on what has happened. Now, some of you might say, things don't look so good right now in the markets, right? The Fed is raising rates. We seem to be entering a recession. At least that's what everybody's saying. Here's what Greenblatt would say to that. Every time in the last 30 years that we've been in the 92nd percentile towards cheap, it's looked at least this bad, okay? Things are cheap because it looks bad, all right? So just keep that in mind. If you think, oh, this looks awful, well, that's how it looks. when things get really cheap. So just, mull that over a little bit. There's a huge dichotomy between the way we perceive value, this is Gotham Capital, and what the market is paying for it. Okay, so essentially Joel just sees an incredible opportunity in buying value stocks right now, buying things that are very cheap according to the criteria that Gotham uses, which is kind of enterprise value to free cash flow yield. I'm going to go a little bit forward here to 27. So there's a data point here. This is when the market was, these bottom 20% cheapest companies were as cheap as they've ever been in the history of these 30 years where Gotham has been collecting data. On March 2nd, 2009, okay, the Gotham yield, the Gotham free cash flow yield, was 24%. That was the 100th percentile, okay? Now the 2-year forward return was 178%, okay? That's almost 90% a year. So it just goes to show you the 92nd percentile to the 100th percentile, they don't seem that far apart, only 8%, but it's the difference between an estimated 30% return per year and 90% return per year. So I just thought that was a fascinating data point. He also says, if you can close your eyes for 2 years, on average, that's what's going to happen. Okay, on average, 61% for this cheapest 20% basket over the next 2 years. That doesn't mean it won't fall 30% from here. Okay. That's something, investors have to realize. Nothing is predictable in the short term, okay? When you look out 2, 3, 5 years, it's easier to have a higher degree of confidence that things are going to shake out a certain way. Obviously, there are no guarantees. But the nice thing about using a basket like this, when you're looking at the least expensive 20%, of companies, that's 280 companies, right, out of 1,400. So if you're able to do that, like Gotham is, that's really going to benefit you in terms of, getting rid of the volatility, right? The individual stocks in that 280 are going to be all over the place. But if you can get a basket, it's really going to smooth things out. What else do I want to say? The last man standing will be time arbitrage. Okay, and again, he gets back to patience as kind of the ultimate edge for the value investor. Patience is in short supply because everyone is looking to make money in the next year or two. Okay, don't play that game. That is a very crowded game to play. Take a little longer time horizon than others do. Then towards the end here, we don't use forward earnings estimates, okay? They don't use anything looking forward to come up with these baskets of companies. We buy a basket of companies based on cash flows over the last few years. So looking in the rear view mirror, this is our best guess of value going forward. We haven't been able to improve on it using estimates, okay? So there you go, right? You don't need to be able to predict the future to use a strategy like this. You can look in the rear view mirror and, come up with an accurate sense of what companies have done over the last couple of years and assume that that's largely going to continue into the future. At least that's how Joel does it. And again, if you have enough stocks to make up a basket like this, that can be a very successful strategy. He says, we'd never buy one company based on past earnings, okay? So if you're trying to decide whether or not to invest in X company, and you're looking back a couple of years at the free cash flows, that's not going to be a great indicator about how that company is going to do going forward. So you really need the larger numbers here to make that strategy work. And then lastly, he talks about Michael Burry. He was asked, how did you come across Michael Burry? How did you decide to seed his fund? And I actually messed this up on Twitter. I thought Michael Burry had been submitting ideas to the Value Investors Club, and that's how Greenblatt found out about Burry. But Michael Burry actually had his own website where he was writing up different investment ideas. And Greenblatt came across it and was just very impressed at how Burry was thinking through different investment ideas. Just a very clear and logical kind of framework for how he thought about investment opportunities. So that's really how Greenblatt came to seed Scion Asset Management, Michael Burry's fund. So I think that's it, guys. I definitely recommend watching this whole Q&A. It's only 56 minutes long. It's pretty fresh, just a month and a half ago. And there's a lot in here to kind of chew on. So obviously, whenever you get a guy who's generated 50% returns in the market over a decade, there's just a lot of learning opportunities that go along with that. So I will leave it there, guys. Thanks for watching, and I will see you in the next one. Take care.